Hello there. My name is Miles Pitcher. I own Superior Lending. I've been in the business 23 years now. I get a lot of questions about FHA loans and their mortgage insurance. So we're going to dive into it today. We're going to answer some questions such as, can my mortgage insurance, FHA mortgage insurance, get removed once I have 20% equity in the home? What is this upfront mortgage insurance premium and why is it so expensive? Why is FHA more advantageous in the mortgage insurance part of the loan than conventional? We're going to dive into all of these, but before we do, if you would hit that like button and subscribe button for me, that would be awesome. First, I want to remind you of the benefits of an FHA loan. You need to keep these in mind. First of all, they allow for a very low down payment, 3.5%. One of our favorite reasons is there's a flexibility in credit score. We commonly do FHA loans all the way down to 580 credit score, and sometimes you can even go as low as 500 on there. They have great fixed rates and adjustable rates. Sometimes they have the best adjustable rates out there if you're looking at doing an ARM. And then the one we love big time is a streamline refinance. What that means is if rates have dropped and you've been in your mortgage for at least 6 months, 6 payments in that FHA mortgage, we can streamline you without having to do another appraisal and most likely without having to qualify again. Is really, really good. There's a few things with that, but we won't dive into that on this video. And then, of course, typically our FHA loans carry lower interest rates than conventional loans. I want you to know that all those benefits come because of the mortgage insurance tied to these FHA loans. So that's why we have it. It provides some really great benefits. It lowers the risk to the lenders who are willing to extend these loans to you by having this insurance on these loans. So let's dig into it a little bit. There's two parts to the mortgage insurance. First is the upfront mortgage insurance premium, and then there's what they call the annual mortgage insurance premium. And I know that says annual, but you pay it monthly. So we'll dive into details on both of these. First, the upfront mortgage insurance premium, you may see it show up like this on your loan estimate. This is off the second page of the loan estimate. It looks like a big chunk. Okay. It's required on all FHA purchases, refinances, and I have a little caveat on the refinances we'll address in a minute, and it is typically rolled into the loan. On rare occasions, we see somebody who wants to pay it all up front, and it has to be fully paid up front, meaning you can't roll half of it into your loan and pay for the other half in cash at closing. It's an all or nothing type of a thing. Right now, as of 2024, the upfront premium is 1.75% of the loan amount. Okay. So on a $500,000 loan, this is going to be $8,750. It gets rolled into your loan balance. Now, when you think about refinancing, if you're coming from an FHA loan and doing a refinance into another FHA loan, like a streamline, you have the possibility of getting a partial refund of your original mortgage insurance premium refunded back to you, so that it helps give you a little credit. Because when you do the refinance, you're going to get charged the 1.75 again, but it gets offset by this refund that you may have coming to you. What does that look like? It looks like this. So if you've been in your mortgage, let's say 1 year and 4 months, if you follow the chart over here, you're going to get 50% of your original mortgage insurance premium refunded back to you. So depending on how long you've been in that mortgage, you'll get a portion of it refunded back to you. Let me emphasize, this is if your old loan was an FHA and you're moving to another FHA loan. If you were conventional and tried to come to FHA, there's no refund. If the old loan was FHA and you refi to a conventional, there's no refund. Okay, it's FHA to FHA. Okay, now let's talk about monthly mortgage or the annual MIP. Okay, this is how it would look on the front page 1 of your loan estimate or closing disclosure. It would show up right there. So it's required on FHA loans, purchases, and refis. Even if you put 20% down, you will still have to pay the monthly mortgage insurance premium. Okay. So one of the things you need to know about, and we love this, is your MIP rate does not change based on your credit score. If you're doing a conventional loan, it absolutely, the rate of what you pay changes. So if you have an 800 credit score, you most likely should be looking at conventional, okay? Because they call that PMI, private mortgage insurance, will be the factors of credit score will affect that. But with FHA, whether you have a 580 credit score or an 800 score, your MIP rate is going to be the same. So the mortgage insurance premium for FHA is determined by your loan amount first, how much down payment or your loan to value or equity in the home that you have, and how long or what your loan term is. Okay. So let me make this bigger. So this is a section of our chart that helps us determine what it is. So the yellow shows that this is for loans longer than 15 years. So this will typically be our 30-year mortgages. If you see the red arrow, that line right there says, if you're putting 10% down or more, your mortgage insurance will last 11 years. So after you keep this FHA loan for 11 years, the mortgage insurance comes off. And you can see that the mortgage insurance premium factor is 0.5%. Okay. Now, if you put 5% down, which is the second line in the table, you can see the factor is 0.5. But when it says mortgage term, that means the mortgage insurance is going to stay on for the life of the loan. Most of our clients are putting down anywhere from 3.5% to 5% down. Therefore, their mortgage insurance factor is 0.55, and their mortgage insurance is going to stay on for the life of the FHA loan. So just be aware of that. Some people think that if they put 20% down or add extra principal down or the value of their home goes up, that the FHA mortgage insurance premium is going to drop off. Not necessarily, right? So how do we calculate this? Let's go through this a little bit. So the actual calculation is based on the annual average outstanding balance. And you're like, huh, what? So for those who want to totally dive into the weeds and know the calculations, I've pasted it right here. Okay. This, if you want to know with exactness, just have your loan officer do the calculation for you, but it's all right here. Okay. So here's how I ballpark it when I have a client who wants to know. We're going to take our loan amount times our annual MIP amount, and we'll use 0.55. We divide and multiply that, then we divide by 12 to get our monthly amount. So $500,000 loan, there's our 0.55. We divide by 12. We're going to be paying around $229. The fact is the actual is $227 because the actual averages out what your outstanding loan balance will be for the next year. And that's what the 227 is. Okay. All right. Let me show you the rest of this chart here. I'll make this big. So you'll see that the chart now, the bottom half includes mortgage loans less than at 15 years or less. Okay. So the bottom half is for our 15-year loans or less. And you can see the great improvement in the mortgage insurance premium. For example, if you looked right there, if you put down 10% or more, you're going to be paying a mortgage insurance premium of 0.15. But the mortgage insurance will stick for 11 years. You can also see that if your loan amount's over $726,200, you're going to be paying a little bit more in mortgage insurance. These are in the high cost areas. Where I live, Utah, our max FHA loan limit is 601. So we really don't, most of the state of Utah, we don't need to worry about that. So here's how you can get a hold of us if you have any questions or we can help you on this. Again, mortgage insurance is there. There's some pros and cons to it. It is a huge help in making these FHA loans super valuable for our clients. Have a great day. Thank you.